So thank you everyone for joining. If you don't know who I am, my name is Nell Boyd and I'm one of the committee members for Women in Finance. So this will be a really great event with Thomas Hayes. So Thomas Hayes is chairman and managing member of Gray Hill Capital, LLC, which is an equity long-short hedge fund based in New York. He is a Columbia University graduate and he serves on the pension commission for the town of Ridgefield, Connecticut, where he lives with his wife and two daughters. He makes regular TV appearances on Fox Business, Yahoo Finance, Bloomberg, BBC, CGTN America, Cheddar, OAN, and I-24 News. As well, he's frequently quoted in the Wall Street Journal, Financial Times, CNBC, Reuters, Fortune, USA Today, US News and World Report, Kiplinger, and MarketWatch. You can also find his stock market commentary and insights at hedgefundtips.com, as well as his weekly podcast/videocast, Hedge Fund Tips with Tom Hayes. These are great resources to learn more about the industry, so if you have time, I'll send the link there and you can check them out. So while this definitely isn't your usual scene, we thank you very much for joining us today.
Thanks for having me. It's a pleasure to be here. I had a chance to look up University of Bristol and the beautiful campus. I thought maybe y'all were at Hogwarts and in a Harry Potter film, but it looks like a lovely place and certainly a well-regarded university. I think you have 9 Nobel laureate alumni. So, the guests may be the most intelligent people on this call, but I'll try my best.
We appreciate that. Yeah, it's definitely a beautiful university. So to start things off, it'd be great to know about how you broke into the hedge fund industry and how you progressed in your career.
Yeah, well, I have the most unconventional entrance into the hedge fund business in history. I think you'll find it hard to disprove that. Actually, I ran a successful business in my 20s in marketing and distribution in the nutritional supplement business. So I had made some money as an entrepreneur in my 20s. Now, I always had a deep interest in the markets. And ironically, I started in my late teens trading commodities and had some early success throughout Columbia. Undergrad, I would sneak into the business school, and I came across a book that really planted the seeds for my interest and lifelong interest in the markets, which was called Market Wizards. It's the original copy. I had some of the greatest traders that went on to become centimillionaires and billionaires from the 70s and 80s. And I'd strongly recommend that for anyone watching. It's by Jack Schwager. And then he has a series of subsequent volumes, Market Wizards 2, Stock Market Wizards, Hedge Fund Wizards, et cetera, et cetera, et cetera. But that was really that opened my eyes to the world of the markets. And while I was building my business in my 20s, all the cash that it would throw off, I would reinvest in the markets. And what happened was, of course, you meet the woman of your life, your soulmate, and I asked her to go online and look for commercial foreclosed industrial properties in Nevada during the great financial crisis in 08 and 09. And instead, she came up with this gorgeous foreclosed house in Connecticut. So we wound up moving out to Connecticut. And my next door neighbor, who lived in the old Henry Luce estate, we became close friends. Henry Luce was an ambassador, ran Time magazine for some time. And I got to know him. He was a very successful businessman, a private equity guy. And I told him I had an interest in the stock market, in value investing, et cetera. And he put me in touch with a hedge fund manager that he had invested money with. And I went down to meet him. He was out of Carl Icahn's old offices. For those of you who don't know Carl Icahn, you can Google him. He was kind of a corporate raider in the 80s. He's on the Forbes 400 list. And he took the TWA money and he built this grandiose office with oak paneling, the same people that did the Senate in Washington, D.C., in the middle of suburbia, Bedford, New York, Mount Kisco, New York. And that's where I met him. And I was, a little bit nervous. I walked into this grand office and grand, like a lair, basically. It was literally like the scene from Wall Street, where they walk into, where Charlie Sheen walks into Gecko's office, and there's this huge, grand oak paneled office. And I told him my story, and I told him my interest in markets. And I said, look, I just want to get involved. I'll work for free. I've got some money, and we worked out a reasonable salary, and I went to work for him, and it was on a trial basis, and I hit the ground running. And I'm going to give you some tips because he's the 4 seed investors. The name of that fund was called Bedford Oak Advisors, and the 4 seed investors were Mario Gabelli, Phil Frost, Michael Bloomberg. And is basically seeded by a bunch of billionaires. The principal was very good friends with Warren Buffett, so we would go out to the annual meeting each year. But the key things is he didn't kind of take me under his wing and show me the magic key. He steered me in the right directions, and I think that's the most important thing, is to have self-initiative. So whenever people say, well, what should I do to get into the markets? I say, look, first and foremost, for my money, the best way to learn business is to follow Warren Buffett. And the number one thing I tell new people to do is to read every single annual letter that Warren Buffett has ever written. And they're all available for free if you go to berkshirehathaway.com and read one a night or one a week for the next year. You will know more about business and investing than 90% of the professionals that are already in the business. That's number one. And then number two, if you want to save 50 weeks of reading and figure out if this is really for you or not, my best suggestion is to read Warren Buffett's favorite book, which is The Intelligent Investor by Ben Graham. And there's something about that book that when you read it, within a few hours, you're going to know immediately. Either the light bulb turns on and your life is never the same, and this is what you should do with the rest of your life, or it's just another book. And if that's the case, that will save you a lot of time and effort in life, because there are plenty of ways to get successful in life. A lot of people say, are interested in hedge funds or in money management because they think that that's the clear path to make the most money in the short amount of time. And if you go into it for that reason, I think you're going to find yourself disappointed or making the wrong decisions that don't ultimately lead to that outcome. There are plenty of ways to make a lot of money if that's your primary objective. I would say the second lesson that I learned working for this gentleman was that the core way to earn money, you've got to control capital. And if you remember 2 words from this interview 10 years down the road, is if you want to build wealth, you need to control capital. And you can do that a few ways. Number one, you can manage outside money, and you have control of a vast pool of capital, and you get a small percentage when you do well for your clients. Second way is real estate is a great way to control capital. You have these assets. Banks will loan you money against the assets. You're going to control a lot of other people's money against the assets and get a small percentage of the upside, which can be massive on that basis. And that's another way. And then the third way is through the public markets. Your Elon Musks of the world, people who start businesses, create equity, and then use the public markets to raise massive amounts of capital, and they own a percentage of the business, and they build their wealth that way. So if wealth is a primary objective for anyone listening to this video cast, then those are basically the 3 different directions that I've found over the years.
Yeah, we definitely appreciate that advice and the book recommendation. So that's definitely a good way to get in. Get in because you're passionate, not because you just want to make a quick buck. But when you were starting out, was there any particular character or manager that inspired you when you were starting out? Who did you look up to and want to be like, or eventually want to beat?
Yeah, I think really, I would say initially when I started reading about the markets, I was really fascinated by George Soros and the shorting of the pound story and reflexivity and all of those factors. But as I came to work in the hedge fund world, I guess my first mentor, it was because of him that I got introduced to Warren Buffett and the annual meetings and that style. And in that context, one of the things that Buffett did, you'll see pictures, he has these old green binders of value line investment surveys. And people laugh at this. You can get them free at the public library, or you can, subscribe to it, or whatever you want to do. but it basically chronicles about 2,000 or 3,000 companies, the larger companies in the different indices. And they do like a page on each company. And you can see how earnings per share have progressed over the last 10 to 15 years. Book value per share has progressed. Cash flow per share has progressed. And then they do a little write-up. And one of the things you can do is just study 5 companies a day of the value line. If you want to go, I'm a value tilt manager. We'll get into what that means. But if you study 5 companies a day, you read these 5 pages every single day, and you discipline, after a year, you're going to know 1,500 companies tangentially. Obviously, you've got to drill down and do more research to invest. But if you start to know a lot of these and spread your net wide and learn that stuff, that's going to be very, very helpful. And then the other thing that I would suggest is start to study for the CFA, or at least read the materials. So that got me off to a quick start at my first hedge fund, not coming from the industry when I started, and a little later on than many of you.
Yeah, I mean, definitely taking that initiative and trying to study and learn these companies and learn what the markets are in the industry would definitely be some great advice for everyone here to follow if you tend to break in.
Yeah, and I just want to add, Nell, I didn't get to your other question about who I looked up to. So I certainly Warren Buffett, number one. Read everything about him you can. Lee Cooperman is another one that I have a tremendous amount of respect for. I've met him at several hedge fund dinners in New York City. Just a terrific guy. He's a philanthropist. Now he's converted to a family office, but one of the smartest thinkers in the business. Obviously, Carl Icahn, he likes to rattle the cage a little more. He's an activist investor. But the thing that I admire about Carl, and I think I probably mimic intentionally or unintentionally, while I'm not an activist, I do like to buy what's out of favor. And that's what Carl Icahn has done his entire career, is buy assets and businesses when no one else wants them, not speculative assets, not gambles, but companies that were big and just came out of favor or came through a certain part in the economic cycle. And then he just waits 3 or 4 years till the thing's doubled or tripled, and then he gets out of it. So I admire that. Bill Miller's another. So you can see I'm in this value direction. Bill Miller, Mario Gabelli took us out to the annual meeting on his plane a couple times, which was pretty fun out of Westchester Airport. That was opened the world for me at a young age. And then David Tepper, who now owns a professional football team, but he still has his fund. David Tepper is a similar. All of these are pretty much, and Charlie Munger, of course, they're pretty much the same style. They buy high quality assets or businesses when they're out of favor or they're going through a period of either sector or market dislocation. And they do the old adage, which very few managers do properly, is buy low and sell high.
Mm-hmm. Yeah, thank you for those names. Everyone, do check them out if you have time. So you mentioned you tend to be a contrarian investor, buy kind of what's out of favor, or buy low, sell high. And your strategy, equity long short, how do you approach that? What's your risk towards that? How much you're willing to bet in terms of certain market conditions?
Yeah, sometimes the softballs, Warren Buffett talks about you can keep your bat on the shoulder until the fastball comes right down the middle of the plate. There's no penalty in money management for not swinging. And sometimes things come down the pike that are just too good to ignore. Last year was one example of that. We put our biggest position ever by weight. It was 20% of the portfolio into Wells Fargo. And Wells Fargo was trading at a 55% discount to book value, which is only traded at a 50% discount to book 2 other times in its long storied history. One was during the great financial crisis in 08 and 09, and one was in the early 90s during the S&L crisis. So we liked the margin of safety in that business. It was bad headline after bad headline. We started buying it at $28 a share. It kept going against us. And what most fast money people would say, oh, it's below a stop loss or some ridiculous thing because they don't know what they own. and we just kept buying down, and it actually bottomed around $22. Our basis, we started at 28. Our basis was $25, and today I think it's right around $50 if it didn't hit that yesterday. So in less than a year's time, that's a double, and then some derivative exposure as well. You can juice the returns beyond that, but those are the type of things that are interesting to us. We're working on a big one the last few weeks that's been very unpopular, that's starting to work. Happy to talk about that now or later in the call.
Yeah, feel free. That's really interesting stuff, so we'd like to hear it.
Yeah, so I mean, another big contrarian call was into the 2016 election. The small cap indices were trading down. No one wanted them. They were absolutely collapsing right into the election day. And we bought a huge amount of upside derivative exposure on the small cap index. You can express it through the IWM, and those made about 20x on a derivative basis. Another trade that was actually got me. So my first fund I was at for 4 years. We can go. I had some great experiences there. How I moved to the second fund was, and this is a really good advice because a lot of you are looking for jobs, and the mistake people make coming out of college is like, wow, I have this degree, I'm entitled to a job, and that's not the way the world works. So how do you set yourself apart? And the way you set yourself apart is by giving value before you expect anything in return. So what I did with this group, I had read about them I don't know if you guys saw the movie The Big Short. They got the housing correction correct by buying credit default swaps on mortgage-backed securities. And so I understood their style. I'd done my research, and I had a trade setting up in soybeans. So soybeans, I guess it was summer of 2012, were trading up dramatically high because there was effectively a drought, and what the current price was pricing in was that it was never going to rain again where soybeans were grown, and I took the other side of that trade and I wrote it up. Okay, so you write up your best ideas that you've researched and you feel confident. I wrote up the trade. I sent it over to them. They put about 1% of their portfolio. It was long puts on soybeans 3 or 4 months out. They made 5x. So they made at that time they were relatively small. I think they were running about 500 million. They put 1% or $5 million. They made 25 million bucks over the next few months, and they said, we'd love to do something with you. And I went on to do some work with them for a couple years before starting my own fund. But sending a resume over would have not really gotten my foot in the door. It's managers want to know how you think. Do you have an account that you're trading? Do you have decent results? If not, then do you have a really strong, highly researched, high conviction idea that you can write down and send to a manager where they'll agree or disagree, but at least they'll see your thought process and see what potential is there to either teach you or shape you or mold you, and if you have a fit. So that's the type of things that I would do to get my foot in the door for managers. As it relates to current trade, so that was some good trades. There's a number we can go through, but I think you'd probably learn more from my worst trade if you have any interest in that.
Yeah, that was my next question actually for you. So what is both the best and the worst trade that you've made, and how has that kind of changed how you approach the market and your investment process?
Yeah, so a couple of years ago, we started putting on a company called Range Resources. It's a natural gas producer in Marcellus Shale. And we started putting it on around $11 a share. It was down from $90 a share. So, I mean, we were certainly being a contrarian. So we started buying it at about 11. It shot up to 18. We thought we were smart. And then over the next 15 months, it collapsed down during the pandemic to as low as $1.61. So what a technical analyst would do would be when it dropped below 11, they would sell it because they're looking at lines on a chart and support and resistance and yada, yada. And there's nothing wrong with that. And there are people that make money doing that. But we knew what we owned. We knew that the balance sheet was strong. We were confident in management. We knew there was, obviously a short-term glut of natural gas production, but we liked the long-term play as an inflation hedge. We liked the energy business in general. Certainly the pandemic, no one could have predicted. But rather than puke out of the position, because we had done proper research, we actually bought down, just like we did in Wells Fargo. And what turned out, what was a horrible trade, turned out to be a fantastic trade. So we bought down to all the way down to 161, and the position became a decent size in doing that. Our basis on that was down to, we brought it down from 11 and change to $4.51 during the pandemic. Today, I think it's up over $24, $25. So that's, six bagger in, even if you include when we started in, 2.5, 3 years. And it's interesting because during that period, some of our smaller clients were like, well, are you going to get out of it? Are you going to get out of it? And they didn't believe in it because they didn't do the research. One in particular, and they missed out on a monster 3-year period. One client that we really liked was a smaller client. They didn't want to be in it. Their account would be up probably in total 2 or 3x by now from when they bowed out. What we've done now is our minimum is now $5 million. So we're dealing with sophisticated people. And when things like last year, Wells Fargo moves against us, rather than smaller clients at $1 million or $2 million that would see, oh, should we, you started at 28, it's at 22, should we get out? The wealthier people got wealthy because they have a certain mindset. So the type of phone calls I get today, if you buy something at 28 and it goes down to 22 because they've seen what I've done over and over and over, did you buy more? And a great example of that right now, which you asked, is Alibaba. Okay, this has been the most unloved sector over the summer. We started buying some around 210, and it's just gone against, and we've continued to build the position. You saw Charlie Munger, who's Warren Buffett's side partner. He has his investment vehicle through the Daily Journal. And apparently he's been doing what we've been doing. He started earlier than us. We've calculated his basis is below 180 and 200. Ours is now materially below that. We bought a ton. We didn't get the 138 print, but we got a ton in the high 140s of stock. And now it's up, I think it hit 180 today. This thing is moving. And why could we have that level of conviction with all the bad headlines and the Chinese government crackdown and the tech crackdown? Is because we did our homework and we understood, number one, this happens every 3 to 4 years in China. You have a crackdown, the general indices drop 30, 35 to 40%. We got down right in that ballpark. And then the crackdown goes away in the intrinsic value. But why could we have so much confidence to keep adding when it was just looked like it was dropping to the floor, from the low to, it was a $320 stock a year and a half ago. We weren't buying there, obviously. But why, when we started just above 200, why would we keep adding? And why would we have even more conviction in the 140s? And that's because when we did our research, we realized, number one, we were paying the same price for the business today as it was 4 years ago in 2017. The difference is their earnings power. The business was 1/3 the size it is today, and yet it was the same price in terms of earnings per share, cash flow per share, revenues per share. So we were getting the same business, at a third, the same price as when it was a third. And if you look at future earnings projections, and if you look even through the crackdown, revenue has been unimpaired. Earnings have flatlined in the short term because they have to deal with the compliance issues. But it's expected to go out. But it's going to double again over the next 2 years, and I'm buying it at the same price as when it was a third. So those are the type of situations that come around rarely, like Wells Fargo trading at a 50-55% discount to book, which only happens a few other times with the China crackdowns. And the most important thing that I could share from my experience, when you have these beautiful periods of dislocation, when everyone else is running for the hills and you step in, make sure you're buying the highest of high quality businesses during those periods of dislocation, and you don't get caught with some mid or small cap that can cease to exist. You've got to be in the best, and you can't replicate Baba. Yes, they'll have competition, but they've got 1 billion users, and we think that's going to be nice. And then we were edified when we saw in the most recent filing a couple of weeks ago that Charlie Munger did the exact same thing. He doubled down last quarter, and it's no wonder he's on the Forbes 400 for many, many decades.
Yeah, I was speaking of Chinese equity. One other company that's been in the news as of late is Evergrande. There are many fears about its debt collapse and potential global contagion. So, how would, if you're invested in China and thinking about that, how would you prepare for that? Or what do you think is going to be? You think it's going to be more of like a Lehman Brothers or an LTCM collapse? Or what are your thoughts?
Yeah, I think none of the above. I think that's going to be contained to China. The government has to ring fence it. Number one, they have the 20th Congress where Xi Jinping is set to take a third term of power next year, but you don't want some type of mass blow up that leads to a widespread unemployment and protests before taking your third term of power. So from what I've been seeing, it looks like that some of the assets will be effectively nationalized. The U.S. denominated debt holders will probably lose their money. The local denominated bond holders will be made whole. The local buyers of the wealth management yield products will be made whole, and life will go on. So this is part of the Chinese strategy. They have a 3 red line strategy. They're trying to shift the investment. A lot of their growth has been driven by investment in non-productive assets like real estate, et cetera. And they want that investment to shift to manufacturing, high tech, R&D. And they've acknowledged that they're going to have a slowdown in GDP in the short term while they make this transition to the long term, getting away from speculative driven property growth type of investment and into innovative semiconductors, tech, things that are going to drive the future, electric cars, et cetera. So it'll be a little bit bumpy. There will be other players in the property field that have similar problems. It's 25% of GDP. The property market is in China, which is much higher than the developed world, dramatically higher. So yeah, it will have impacts in China predominantly. There may be some ripple effect if some foreign banks have exposure, but I think it will be subdued. I think the government will step in and ring fence it, and that type of bad headline that looks like the world is ending is what creates the opportunity to buy a high quality, unrelated. Alibaba has very limited, if not no, exposure to property, and their growth moving forward is going to be in AliCloud, in the cloud-based services to rival Amazon Web Services, and they're growing internationally. So the Evergrande Ripple served up the opportunity in the Alibabas of China that if you look 3-4 years out, it will be an opportunity. And and if Alibaba dropped $20 tomorrow, we'd be in the market buying it. And that's just really how we think about things.
Mm-hmm. So there's always opportunity in some form of disaster somewhere.
Yeah, and I think as you asked about the strategy, we're kind of top down, bottom up. So we look at the general market, general economy. Is this a time to be adding a lot of risk? Is this a time to be lightening up and taking some risk off the table? And then we drill down to sectors. So on the basis of we want to add some risk, what sectors have been beaten up of late and why? So sometimes things are cheap for a reason and we stay away, but we want to look at, or is this just out of favor? Is this a short-term phenomenon because of something happening, whether it's rates or policy or general market weakness, et cetera. And then when we find a few sectors that are beaten down, then we look and drill down to individual companies, and then we start the research process. And over time, as you've learned a lot of companies, you're going to see the same patterns repeat over and over and over, and stick with high quality when it's on sale, and you can't go wrong.
Mhm. Yeah. So in the sectors that you're watching, the industries that you're watching, are you expecting any major disruptions? What about when earnings season is rolling around now? Any companies to make a splash, either positive or negatively?
Yeah, I think, the market generally came into this earnings season excessively pessimistic with labor shortages, supply chain bottlenecks, fears of inflation, stagflation, you name it. The market was very pessimistic in September. Earnings estimate growth for Q3 year on year was 27.5% growth off a low base, of course. But if you look over the last 5 years, earnings have beat by about 9% on average, which means the growth would be about 35%, much higher than people expected. And if you look at the last 5 quarters, earnings have beat by 19.1%. So that would put earnings growth for the third quarter up above 40%. And no one was expecting that. If anything, people were thinking they were going to miss the 27% estimates. And why that's important is because the market's a discounting mechanism. It looks forward. So why do we care about what happened last quarter? Is because if the beat is that large, it means they're going to have to take up forward earnings guidance. And we think that consensus earnings estimates for the S&P 500 for 2023, rather 2022, are too low. Right now, they're at $220 a share. They've been flat for the last 4 or 5 weeks. We think by the time this earnings season is over, that estimate is going to go up to $230 and beyond, which is going to make the market look a lot less expensive than it is. It'll bring the multiple down in line with the last 5-year average. And that's why you're seeing money start to chase into the market. All the money that was pessimistic, that missed the opportunity to buy stocks in September, is now frantically chasing into year end. And you're seeing that in the last few days.
So you would be in the opinion that the S&P is an overvalued as of now. For your strategy, does it really matter if the S&P is overvalued or if it's undervalued, as long as the goal is to generate alpha? Isn't it just about how you trade that?
Yeah, I think you're spot on both questions. So one, it's fairly to richly valued. I mean, relative to rates, it's reasonably valued, but rates, as we know, are probably going to creep upward after a long downtrend. And when that discount rate increases, the value of future cash flows becomes less in the present. So those multiples, might start to come in a little bit. What we did in September and August is everyone was worried about a September swoon. Well, there were plenty of sectors that had summer swoons, like the reopening cyclical and value trades, like industrials in particular. And we used the opportunity to load up on some companies like Lockheed Martin. Lockheed Martin was trading down, I think, 17% off its recent high. It was trading 15% off of its pre-pandemic high. And why that's important is because it's going to earn 27% more next year than it did pre-pandemic, and yet it's trading at a 15% discount. So that was something we liked. We liked Boeing. We started adding aggressively there. We think that the negativity with the 737 MAX is overdone, and the next catalyst is going to be the ungrounding of the 737 MAX by China. Not because they love us, but because they need the planes, because they want their economy to hum. And there's a huge backlog. They operate in a duopoly. We think that with the virtual meeting with Biden and Xi coming up this quarter, that could be a catalyst to unthaw relations and get that approved, because the 737 MAX was ungrounded in many countries, including India, in the last 4 or 5 weeks. So there's no reason that we won't see that happen in China. Boeing has projected demand for their planes from China alone over the next 2 decades at $1.47 trillion. So it's just a huge opportunity, and the market served that up this summer in industrials, which were out of favor, and we took advantage of that. So, it's interesting because we were pounding the table last year on banks and energy when no one wanted them. And what you can do is look up, we had a few key calls that were actually chronicled. We do a weekly video cast and podcast. You can go through all that. But MarketWatch picked up on March 18th, 2020, in the middle of the pandemic, the market was down 33% or something, 35%. And we compared it to the Spanish flu of 1918. And we said, look, during the Spanish flu, the Dow only fell 33%. We think we're nearing a bottom, and we're aggressively buying. The next day was actually the bottom. The Fed, there were rumblings they were going to backstop the corporate credit market, and the game was on. So you can look at those and just see track records of different managers that you like and follow. The same thing with Wells Fargo. We put out a note on our blog. You mentioned hedgefundtips.com about Wells Fargo when it was at, and you can see it in MarketWatch. The author of both of those was Sean Langlois, Langlois or something. He's no longer there, but if you Google Tom Hayes Great Hill MarketWatch, they'll come up. And just recently, they picked up a note that last week I put out on Alibaba. So we'll see if third time's the charm or not. But they seem to have their timing spot on over there, and it's fun to do those. You know, contrarianism is doing your research, betting against the market, and when you go against the crowd, a lot of times you'll make money with the crowd. So you don't want to always be contrarian just to be contrarian. You want to have a reason, like what's missing. Is it just forced deleveraging? Sometimes it's a structural dislocation that you can take advantage of and just get high quality on sale. And that's what we do over and over and over.
Mm-hmm. So being contrarian, but within limits, and being wise about it, and doing, as you said, your homework about choosing which your investments are. But thinking back to March of 2020, or the VIX was at 66, is almost the same as 08. But now today it's down to 15. So does your process change, when it's super volatile versus when it's not as volatile? And, how do you approach that?
Yeah, you just have to be more surgical. So I think to your point, is the market overvalued? Some pockets certainly are, but some pockets are cheap. Another one that we leaned into of late that's just starting to move is Cigna. No one wanted the health insurers. You've seen UNH report good earnings. We think that whole group is going to continue to do well. I think Anthem reported this morning good earnings. So we have to look a little harder to find those things that are still on sale, even if the general indices, because I think you wanted to talk a little bit about the heavy weight of tech in the S&P 500 and will that persist? So, if the general indices are going up, but you can look under the surface and see that there was something like some big percentage, I think in September, 90% of the NASDAQ 100 had corrected 10% or more. So under the surface, there was a lot of opportunity. If you look at those stocks of S&P 500 stocks that are above their 50 or 200-day moving average, not that line has any significance, it just gives you an idea relative to other periods in the past. So while the indices were holding steady due to a handful of stocks that make up 25% of the weight, underneath the surface, there were bargains galore to be had. And that's where we try to look. It's like a treasure hunt. I go to work. I skip to work every day. It's like I'm going on a treasure hunt every day, and I couldn't be happier. And there are dozens of different hedge fund strategies. So this may not be the one that resonates with you, but for me, it just suits my personality. And you've got to find something that you absolutely love. And that's why I started off with, read that book, Intelligent Investor. Either it's going to click for you or it's not. If it's not, just cut bait and look somewhere else and find something that you do love.
Mm-hmm. So every day is just cutting through the noise and finding the treasure at the end of the puzzle. That's the good analogy for it, and sounds quite interesting. So another thing that is highly debated is inflation. Is it going to stay or is it going to leave? And Powell has said that the Fed has intentions to begin tapering, but that is going to wait until the employment inflation goals are reached. But, given the Delta variant, supply chain disruptions, and the non-farm miss, when do you think this tapering will begin, and how will you respond to the long and short-term implications of this?
Yeah, this is a great question. So it's almost shocking. The market is convinced that they're going to go ahead with tapering November 2nd because of some recent CPI prints, but the PPI came in a little less than expected. Look, he's made it clear that they have met their, quote, substantial further progress on inflation, and then some, as we all know. But they have not met the target substantial further progress on full employment. And he defined that in his last press conference as, he would need to see another decent jobs report before beginning taper. The problem is he only had the September report when we had huge delta. We had just had the extended unemployment benefits rolling off. So that was a bad report, as we anticipated it would be. I think 195 versus 500,000 created. So he will not have seen another jobs report before November 2nd, which, if he holds true to what he said in the conference, he has no justification to announce the taper in November. Now, by December 14th and 15th, which is the next meeting after that, he will have seen October and November, which I think are going to be much better and will meet his definition of decent. And they can announce in December whether they implement, December 16th. My guess is they're going to implement sometime in the first quarter. And if you look back at 2013, the time between they announced and the time that they implemented, they kind of intimated in May of 2013 that they wanted to start to taper, and they announced and implemented in December of 2013. The 10-year yield rose from 10-year Treasury yield rose from 161 basis points to just under 3% over that period. And ironically, when the taper actually started, the first month of the taper actually started, December, January, 13, 14, it was the peak in the 10-year yield. Most people think that once they stop buying bonds, yields are going to go up more. And I think it's just the opposite. When we've seen a move from 130 basis points to 167 basis points. I think we hit this morning on the 10-year yield. I think we're going to see a two-handle by Q1, maybe 225, maybe 250. I doubt it. Maybe, but that could be the peak of yields for many years, as was the case in January 2014. That was the top in yields for another 5 years. Not after taper was finished, but when taper started was the peak, because the market is a discounting mechanism and it looks ahead. And I think we're going to see a similar situation by the time they actually start in Q1. Yields will hit 225, 10-year yield will hit 225, 250, and that will be the peak for some time to come. And the other thing that leads me to that is sentiment. If you look at the Bank of America Global Fund Manager Survey, which I post a summary on my site, managers are the most underweight bonds ever. And when I see that type of extreme, I start to look at the other side of the trade. I think it's still early to be buying bonds, but I think, if they announce in December or something like that, and yields are over 2%, 225, 250, I'd probably start buying long bonds, which will be a very contrarian move at that time, and I think a very profitable one as well.
It's very interesting. So I will have to, see how it plays out. But sounds like you've got a pretty good handle of what's going to go on. Just one last question to kind of wrap this up, a general question. In light of increased regulatory measures, both domestic in the US and abroad, specifically targeting hedge funds and reporting requirements, how do you see that evolving in the next 5 to 10 years? So what are the issues that you face as a manager today?
Yeah, so it's interesting. Before the great financial crisis, it was a lot easier to start a small hedge fund and grow gradually up to $100 million, which was a nice business. Since Dodd-Frank, since the great financial crisis, they always fight the last war, and they overdid it in terms of the regulatory issues for compliance and that type of things that were unrelated to what happened in the financial crisis, but regulators often don't have that market experience. And they just try to do something as a knee-jerk reaction. So I think it's going to be a little harder for startup hedge funds in the future to grow and to raise money, because you basically have to get to 300 million break even to be break even with all the compliance. So the best suggestion I would have to people listening in and watching this is, if you do like the buy side and you do like all the things we've talked about today, try to find a large hedge fund to start with, to learn the ropes, that has the process, et cetera. And if you do a good job there for 5, 7, 10 years and you build your reputation, they'll either seed you with that first 300 million or get you a few big blocks, and then you can build that way. The game has changed in that regard, and that's why you're seeing some of the biggest funds get bigger. And the bigger they get, the harder it is for them to perform. So there will be a place for new emerging managers, but it'll be harder than David Einhorn and Dan Loeb, starting with 10 million bucks and growing from scratch. Those days have been regulated out. That may change if you get a different administration and they realize that capital formation is an important part of the capitalistic system, and they say, okay, let's increase. Let's go back to before the great financial crisis, because small hedge funds had nothing to do with the ultimate outcome. It was leverage within the banks, et cetera, et cetera. And then you could see that reemerge. But for the time being, given the regulatory environment we're at, you either need to be really, really small or start with a huge fund, make the contacts, learn your stuff, and then they'll seed you and they'll take a piece of your business. And that's probably the best route you can go given the current regulatory environment. But I do think, to your point, the demand for alternative assets is going to continue to grow because when you've had the type of gains that we've had, particularly in the U.S., and returns become more subdued, you need stock pickers are going to get paid handsomely, and we're going to move into a period in a rising rate environment. People who are good at picking stocks tend to dramatically outperform, and that's a similar situation. All those names that I mentioned made their huge stakes that ultimately went on to become billionaires in that higher rate environment in the 70s and the early 80s, like Buffett, like Bill Miller, Lee Cooperman, Carl Icahn, because when you have higher rates, you have a lower correlation of stocks, and you get paid more for being good at picking stocks. And I think we're slowly moving back into that environment. So the opportunities are going to be abundant, and you will see active managers dramatically outperforming if that's the climate we find ourselves in. The good ones.
Yeah, we will very much appreciate your insights. That it will be it. Thank you very much for joining us today as well. And just a reminder, everyone, you can check out hedgefundtips.com as well as Hedge Fund Tips with Tom Hayes. That's video cast and broadcast. Great resources again to check out. And thank you very much for joining us today. And we hope to see you again.
Thanks for having me, Nell.